Welcome, everybody, to the Enlightened Entrepreneur Podcast. And thank you for joining us here to build livelihoods that matter, be your own boss, and make the world an even better place. I'm your host, Julie Sampson, director of the Scheinfeld Center. So let's get right to it. This is the third of 5 podcasts in which we're exploring how the workplace can be redesigned to drive equity and be more rewarding and engaging for workers. This is relevant given the Great Resignation and Reshuffle we're experiencing in the workplace related to the pandemic. Could employee-owned companies be part of the reset? And how does steward ownership fit into the picture to create a transformative impact for employees and businesses alike? Well, joining us to break it down is Sarah Joannides. She's a champion for change and using business as a force for good, partnering with mission-oriented business owners and executives to fully integrate social responsibility and sustainability principles into their core business strategy. She currently serves as managing director of Alternative Ownership Advisors, who are the leading experts in the emerging field of steward ownership. Sarah, welcome, and thank you so much for joining us.
Thanks for having me. It's a pleasure.
Great. Well, let's get right into it. For our viewers, just as a side note before we get going, if you're unfamiliar about this topic, about employee ownership, please check the links down below the video in the description. There's links there to our previous podcasts that can help you get up to speed and then build on that from here with this podcast. Okay, so Sarah, on your company website, you discussed the drive towards employee ownership. What's driving this employee ownership trend, and specifically trust ownership, the movement in the US, and how extensive is the movement?
Great question. So from where I'm sitting, it's really at the very nascent stage in the US in terms of steward ownership or trust ownership. The same isn't true if we were looking at, say, for instance, Europe. There's historic examples of companies like Bosch in Germany and John Lewis Partners in the UK who have been steward owned or trust owned for over a century. They've proven that these models work. They can lead to better outcomes in terms of profitability, resiliency, innovation, and attracting and retaining talent. It's important to understand that the trust movement here is very nascent, but what isn't nascent really is employee ownership. So ESOPs are the dominant form of employee ownership in the US, so employee stock ownership plans. Right now, at least the most current data would put that at over 6,500 companies and covering over 14 million employees. So it's a big movement. And there's many factors that influence that wide adoption of ESOPs, not the least of which are significant tax benefits for the settler, the founder that's putting ownership into an employee stock ownership plan, and for the companies operating under an ESOP. There's also, secondly, the worker cooperative movement has a long and storied history in the US, but they comprise a much smaller piece of the pie in terms of employee ownership. So there's around 600 worker cooperatives in the US right now, so much smaller. Now contrast that to employee ownership trusts, which we think of as the new kid on the block, which are 15 and counting right now. So small but mighty contingency of people in this space.
That's so great to hear. That although it's small, it's growing as the new kid on the block, as you say. So our audience includes startup founders and aspiring entrepreneurs. Could you describe this concept that you have on your website called the Founder's Dilemma, and how trust ownership helps address this dilemma?
Sure, happy to. So from our perspective, we know and we meet all the time mission-driven business owners who come maybe to the end of their career and realize they don't know what to do with their company. So this is what we call the founder's dilemma. They want some liquidity. They certainly earned that, right? All the years of sweat equity and passion they put into their business. But they worry if they cash out and sell to maybe the next biggest company, they're not sure what will happen. They'll lose the control over the future of this company. And so maybe they're thinking that their vision might be watered down. Maybe they're worried about their staff. They might have long-term employees. Will those positions be consolidated to a parent company? Will staff be laid off? Could the headquarters be moved out of town? Most of these folks have a dream. They're not maybe quite sure how it would work, but they have this dream that maybe their business could last for generations, even when they step back. So this is what we call liquidity and legacy, and what we call the founder's dilemma. And trust ownership and the broader umbrella of steward ownership is a way to solve this, to enable business owners to achieve liquidity and legacy. So I can speak a little bit more about steward ownership. It's this method to align your ownership, your governance, and your financing in a way that locks down your purpose and your independence. And steward ownership is essentially a philosophy that describes different types of companies based on the actions that they take. And there are two key principles in this idea of steward ownership. So the first one is that profits of the company should primarily be reinvested in the business and shared with stakeholders, not extracted by shareholders. And that's what we refer to as profits serving purpose. So in the case of an employee ownership trust, employees are the stakeholders that are benefiting. The second idea is around self-governance and independence. So in a steward-owned company, no one has the rights to sell the underlying entity, the underlying company. The voting rights, which are the control rights, are held by the stewards who are selected. They are actively or closely involved with the business. So separate from like a conventional ownership form in steward ownership models, the voting rights and the economic rights are disconnected. And this means that the profit maximizing motive that's generally there when the voting rights and the economic rights are together is kind of switched off. And that allows the company to focus on running a healthy business where the profits serve the purpose and benefit all the stakeholders. And as I said, steward ownership is a general philosophy that covers many different ownership forms, which include both perpetual purpose trusts and employee ownership trusts.
I have a question that kind of came up when you were talking. So some of the elements that you were mentioning sound a lot like the benefits corporation. And so can you maybe contrast the benefits corporation along with these other forms?
Sure. Yeah, this is an area I have a lot of experience in because in my prior experience, I led B Corp certification for the company that I work for. So you may have heard of B Corp certification, which is a certifying entity that certifies your actions as a socially responsible business. And then there's a separate thing, which sounds the same but isn't, which is benefit company adoption in your in the way you're structured. So your legal entity can become a benefit company. It's something you register for. That's it doesn't replace the fact that you're like a C Corp or an S Corp. It's in addition to that. And basically what that does is it requires that you put into your operating agreement, so your like articles of incorporation, that the corporation will take into consideration things other than just profit in making decisions. And so it's sort of a consideration clause. And by doing that, you're setting an intention about how you're going to act as a company. But the thing about benefit corporation status is that it doesn't really have legal teeth. And what I mean by that is that essentially, if you were a public company and you weren't following what you said you would do, your shareholders would have the right to sort of take you to court and say, you're not doing what you said. But in a typical private company, you really don't see that type of thing happening. So there haven't been any examples to date that I know of it being used to actually enforce the purpose and those stakeholder considerations in a way that's really firm. The difference with trust ownership, for example, is that you create a separate agreement that is the purview of the trust. It's called a trust agreement. And in the trust agreement, you document the purpose that has to be driving the company going forward. And you document that the company can't be sold in the future. So it's a very different level of stringency. You're really locking down, you're putting the ownership structure, not just how you act, but how you're owned and financed and governed is legally formed. So it's a deeper way of going. I hugely in favor of B Corp certification and in that movement, but this is just another level for owners that want that sort of certainty and guarantee that they feel like they might not get otherwise.
Oh, that's such a great explanation. Thank you so much for that. That's really relevant because our at the college here, our major demographic is Gen Z, and they are so social good oriented and very entrepreneurial. So as they consider different types of ownership as they move forward, those descriptions will be super helpful. So in our previous podcast in this series, we talked with Rick Plimpton of Optimax and also Brad Hippert of Equity Atlas and about their employee ownership trust. So what is the difference between the EOT and the Perpetual Purpose Trust?
Sure. Good question. So a perpetual purpose trust is a legal form. It is a non-charitable trust where the beneficiary is the company's purpose. So just to break that down a little bit, you might be familiar with like a family trust where the beneficiary is an individual or a group of individuals who benefit from the trust. So it's a way of like moving assets from one to the other. With a purpose trust, the company's purpose is what is enshrined and it benefits from it being placed into the trust. And so this is, and by purpose, I mean something a little bit more higher level or broader than your mission. So mission, people think about it differently, but mission is generally how you're describing what you do. Your vision is oftentimes like why you do it. Your purpose it has to do with why you're choosing this ownership form. So your purpose of the trust, why did we choose the trust is the purpose. So it can be very broad. It could be, we want to, change the face of organic agriculture. And that's why we're putting it into this trust. An employee ownership trust is a perpetual purpose trust, but it has one primary beneficiary, and that is employees. Okay. The difference is, then this is getting into the technical nitty gritty, but an employee ownership trust, the employees are not direct beneficiaries. They're not directly given it doesn't flow to them directly or they don't hold the shares. They actually are just the trust holds the shares on their behalf. So everything about how the company is run, the governance and the leadership and the culture and how the profits are distributed is intended to benefit the employees. So just to summarize, perpetual purpose trust is kind of the big umbrella, and under that is just a subset, which is an employee ownership trust where the beneficiaries are described as the employees.
Okay, that's a great explanation. Thank you so much. Now, to kind of give some example to this, the Organically Grown company, who's a pioneer in the sustainable organic agriculture for over 40 years, and also a pioneer in employee ownership, they are an amazing example of employee ownership in that they transition from nonprofit to co-op to employee stock ownership. ESOP.
Stock ownership plan.
Yeah, plan. That's what I was missing. And then to a perpetual purpose trust. Further, they had so many inquiries about their process and how they manage these transitions that Alternative Ownership Advisors, your company, launched as a subsidiary of the company. Could you walk us through the circumstances that motivated each transition there and through the different types of employee ownership to help us understand, what form might be best at what time, for different companies?
Sure, you bet. So as you said, OGC, I'll use that acronym. OGC is our parent company. So it might seem a little strange that an organic wholesale distributor of produce started an ownership, governance, and financing consulting firm, but that's how this happened. So just to back up to the very beginning, OGC was founded over 40 years ago by a group of farmers. And initially it was just a group of really passionate people, very passionate about organics, and they formed a nonprofit. And their goal was just to promote organic agriculture, this group of farmers. But they realized over time that there was only so much they could do as a nonprofit. And they thought perhaps the best thing we can do is cooperate. We can work together to support each other, share services, share, assets and resources and staff to make sure that we can grow the movement by selling more organic produce, getting more out there, introducing it to consumers. And that worked for a period of time. But we're here in the Northwest, in the Pacific Northwest. And at a certain point, they realized, well, there's only so much we can grow in our region amongst ourselves, this group of farmers that were cooperating together in a co-op. And they thought, in order for it to be sustainable and for us to bring even more attention and drive the market towards organic, what we should be doing is we should be wholesaling other folks' goods as well as our own. So we want to keep selling our produce, but we want to wholesale others. And again, provide a market, connect these other farmers to the market and act as a distributor. And so in order to do that, they actually had to change their ownership structure. So a cooperative was no longer the right way to go. And so they had to form an S Corp, which is just a type of corporation. So they became an S Corp. And some years went by operating under that ownership structure. And a point came in time when they said, at this point, the ownership, when it transitioned from the cooperatives, most of the ownership of the company now is among these founding farmers. But there's a lot of other people that are contributing. There's a lot of other stakeholders that are helping us grow, including the employees that have joined this distribution company. And so they said, we really think that they should have an opportunity to share in the benefits of the company. So they said, how can we do that? How can we bring employees into ownership? And they chose to do employee stock ownership plan. So it's called an S Corp with an ESOP, lots of acronyms. So then they started to think about, I'll just say fast forward to about 5 years ago. The folks at OGC came to a situation where they were rethinking once again, is this ownership formation serving us, serving our to the best benefit, and serving our strategy. And they really were concerned about the ESOP, the employee stock ownership plan. So if you don't know a lot about employee stock ownership plans, they do actually allocate shares of stock to individuals, employees, and those employees, when they leave the company, if they retire or whenever they leave, the company pays them back for those shares. So what you're doing when you're an ESOP is you're constantly rebuying the company in essence. You're taking back, paying people for shares, and then you're giving shares, and then you're taking back shares and you're giving shares. And this actually creates quite a bit of pressure on the business, especially a 40-year-old business where you have people retiring that have like all of this stock that they're cashing in. So you've got that going on. And then the other thing with ESOPs is when you pay out the shares, you have to do that at fair market value. And so what that means is every year you pay a lot of money to have a valuation, and a valuation of your company is based on your performance, 50%, but the other 50% is based on the marketplace. And organic agriculture and organic companies, there's been a lot of like really highly leveraged things happening, a lot of consolidation, a lot of things that have driven up the market. And so the rate of the value of the company was rising much faster than the top line, much faster than revenue, much faster than profits. So they were looking at this chart that was kind of scary because, you had revenues here, and then up here you had potential obligations, and you don't know for sure when those obligations are coming. And they were getting worried about that. So that was one thing. They also were feeling like the administration and the complexity of an ESOP, which some companies feel like, it's well worth that for them. They felt challenged by that. It is expensive and it is complex. They also felt like their population of employees wasn't necessarily very driven by the idea of like a retirement benefit, which is what an ESOP is, the federally regulated retirement benefit. They felt like it wasn't enabling them to put as much in the sort of compensation and benefits bucket as they would like to, because they had to hold it out to pay off folks that were leaving. The last thing is that when you have an ESOP, you have trustees of the ESOP that oversee things. And if ESOP is approached by somebody wanting to buy the company, if that offer is in the best interest of the beneficiaries, so the current people holding stock, the trustees have to say yes. So it's only based on whether or not it's financially beneficial to the current employees. So there's none of those considerations. There's none of those, oh, is this the right thing in terms of, is it in alignment with our mission? Are they going to keep our local employees? Are they going to lay people off? Are they going to consolidate? None of those things go into consideration. And that really gave them, like a feeling of concern. The last thing they wanted to see is being sold off to a larger wholesaler, because again, so much consolidation in the industry, and they really believe that independence was part of their, their competitive advantage. So they were, they were faced with all of these challenges, and they, said, like, they kind of set out, literally, like, made a list, like, if we could build a perfect situation, what would we want? And so what they wanted to be able to give the shareholders, like the early founders, a way to actually move on to create that liquidity that we talked about. They wanted to be able to bring in capital from the outside to grow operations. They've never brought in outside capital before, and they wanted to be able to do that without handing over the steering wheel to investors. And they wanted a way to be able to, like, reward their employees in real time. So to incentivize everyone to work together towards their common goals. And, then also being able to not compromise either their purpose or independence. So that's a big bill to fill. And they kind of went out and talked to a lot of people, and they spent literally a couple of years doing this. And they caught wind of this thing called the Perpetual Purpose Trust. And when they talked through it, they realized it would enable them to bring in those investors without giving away control. It would allow them to grow the business, to give a return to all of their stakeholders, and to maintain this orientation towards purpose and perpetual independence. So while they were previously an employee stock ownership plan was a big part of their ownership, when they moved into this new form, they chose a perpetual purpose trust because they believe so much in this idea that all stakeholders who bring value should have the ability to have a voice in governance and share in economic rewards. So in the coworkers, the employees are one of those 5 groups, but they also keep in mind their farmers, the founding farmers, and all the farmers that they buy from, their clients who are like retailers, grocery stores, their community allies, the people out there doing advocacy around organic agriculture and relieving hunger and all the things that are important. And then finally, their investors. So they see investors as a stakeholder that deserves a return for their investment, but not an outsized return, just on par with everyone else.
Wow, that's an amazing journey, and thank goodness when they were going through all of those changes that there were people around who could help them figure out the way forward, and now we get the benefit of the work that they did, businesses that are moving forward with this. That's amazing. Thank you so much for kind of clarifying that whole journey. So from your perspective, what is the potential, long range about the impact of this continued movement towards employee trust ownership on our U.S. communities and local economies?
Yeah. I mean, I think the movement towards employee ownership, it has such potential to bring so many benefits. So benefits to individuals, communities, and the economy as a whole. So you can think about, increasing job stability, earning potential for workers, bridging, racial wealth disparities, income disparities, increasing business stability, and offering ways to kind of keep the doors open. You mentioned that silver tsunami, that's real, right? That's very real. And people need options. And I heard a data point at some point, or a statistic, and I don't actually remember the number, but the number of people that actually are able to successfully sell their business at the end of their career is actually really small. It's not a big number. And so while we think of that's what you do when you get to the end of your career, a lot are not able to do that. And if this provides an alternative to people to consider, another way that they can think about keeping those doors open, keeping those employees employed, and bringing employees into ownership at the same time and spreading the wealth, it's such a win-win. It's so huge. And the other thing I really want to mention here is that, ESOPs have been a prevalent form, have been incredible for workers in the US, over the last 40, 50 years now. And workers' cooperatives have been an alternative well that has really fit a certain type of company that wants a more democratic, governance and culture. We see employee ownership trusts as adding this third alternative that really helps fill some gaps. Companies that are too small to do an ESOP, or companies that just don't feel like ESOP's the right fit for them, a company that doesn't feel like cooperative is quite right. Like maybe they feel like that's a little bit too much democracy, or even just too much pressure to put on individuals to be like worker owners. So it's this nice little niche that's actually really flexible in terms of like installing it, much less expensive than an ESOP. And you can design it so that the governance and the way you share economic rewards and who you bring in, whose voice is raised up, all of those things is all up to you to design. There's no rules and regulations about how you do that. You just have to create an agreement, a legal agreement that documents it and codifies it.
Are there any situations where companies have really gotten into trouble with this type of ownership?
I don't have any examples. I'm guessing they're probably, I don't think in the US because again, it's so new. But I would imagine there's probably some examples out of the UK, Germany, some of the areas where things have been installed, that have a much more longevity. But part of what got us to this idea of steward ownership were folks in Germany at a nonprofit in Germany that were looking at what companies that had really successful outcomes in terms of the employees and the communities and the longevity, like multi-generational, what did they have in common? That's what they were looking for. They weren't necessarily sure it was one thing or the other, but they just said like, what are the best outcomes? And they started to see how they had similarities. So these trust forms, right, that lock down the independence over time and create like a foundation for multi-generational businesses, and the employee ownership trust in the way that it enables a company to really serve all of its employees and in a very equal and equitable way. And so they just started to kind of pull together this idea, like there's something here that we need to think about. And that's where the steward ownership umbrella kind of came out of.
We have, as I mentioned, a lot of aspiring entrepreneurs and startups in our audience. And as I mentioned, also Gen Z, has this social good emphasis, and also a big emphasis on equity, establishing equity. And so as an educator in the area of entrepreneurship, we see a lot of student pitches, right? And I don't remember seeing, employee ownership as an exit strategy typically brought up in the pitches. And so I'm wondering, bringing these things together, what would be the best approach for aspiring entrepreneurs if they know they want to build this mission into their companies? Can they start? Is it realistic for them to start from the get-go with trying to establish employee ownership, or does it come into play better down the road? What are your thoughts and experience on that?
Yeah, we talked to a lot of entrepreneurs about this. And I think it's really interesting that your last session was with Brad Hibbert, because as far as we know, that's the only case of an employee ownership trust being done from the start of a company's, not as a midstream change of ownership or as an exit strategy. So that's fascinating, but it's definitely a rarity. And I think partially where that comes from is we understand, this idea around the excitement of being part of this employee ownership movement, or part of this idea around like trust ownership and wanting to do things differently. But what our bias is that when entrepreneurs are setting out, that their first and most important priority is just to build that viable product or service that people are going to pay for, and to focus on that. There's so many assumptions that you're making when you're starting off, and they won't be validated until you get out and test it in the marketplace. So this has to be your job one. But we get that people are thinking longer term around what their goals and visions are. So when you start a company, if you haven't taken a whole bunch of outside investors, you hold the steering wheel, you make the decisions, you have the voting rights, right? You're in control. And while you're doing that, you can ensure that you're doing things in a way that you think is the right way, what feels right to you. So taking care of your employees, potentially letting them have a voice in governance, sharing, doing profit sharing, or however you share the benefit of your work with them, you get to make all those decisions in the beginning. Again, assuming you haven't taken a lot of investment on. So you're steering the ship, right? But when things get more complicated is when you think about taking in like a significant equity investment beyond just maybe your friends and family investing, which is how I've always started businesses. So that's kind of a critical juncture when you really need to start thinking about giving away the steering wheel or some portion of the steering wheel, and how that might influence your ability to make choices later into things like an ESOP or an employee ownership trust, or whatever your vision is, a workers cooperative. Trust ownership specifically is, it's a niche now. It'll continue to be, because there's it's a very specific type of founder that believes in these things. So if it's a person that's starting a company that really believes they should be sharing the profits with stakeholders, and not just it's not just part wealth building on their own. If they really believe in that idea that they should be self-governed, that they shouldn't have remote shareholders and board members that don't really understand their business, if they believe in that idea of the self-governance, and if they believe that the business shouldn't be a commodity that can be bought and sold, but it's more like a living system that should go on for generations, those are the types of people. But this last point that I just said about not being a commodity and not being able to be bought and sold is really important to think about when you are a founder and when you're an entrepreneur, because most of us, I've started and sold businesses in the past, you do think about this as a way to build wealth. You invest in this business, you grow it, and at a certain point you sell it and you get your liquidity at that point. But once you put something into a trust ownership, that's a whole different ball of wax. You're actually embedding it into a permanent, perpetual form. So are you ready as an entrepreneur to make that decision? I'd say that's a really big decision. And that's where we encourage people to think a little bit more about putting some stakes in the ground and working towards that. So we talked about B Corp certification. I'm a huge believer in setting some intentions early on. Setting an intention to become B Corp certified is a big thing. It's not easy at all. And so if you said, okay, we're going to start our business and we're going to look at this external third-party standard around how we should operate, how we should treat our staff, the community, our suppliers, how we should govern, and we're going to use that to help us decide, how to act as a company and move in that direction, eventually maybe become B Corp certified. And then, 10 years down the line, maybe if you're really successful and you're looking down the line, you're on that path, right? And you can make a choice at some point to make a change that is right for you and that's right for, for all of the stakeholders. And I should also note that throughout this, I've been talking about trust ownership, or an ESOP for that matter, as a one and done, like it's all or nothing. And actually, there are many, many examples of companies that have a partial employee stock ownership plan. So some individuals own stock, and then the employee ownership sits alongside it, the employee stock ownership plan. The same thing is true of an employee ownership trust. So you could picture an idea where you get to that point where you're feeling like this is the direction you want to go, and you start a partial trust, which signals that direction you're going in and allows you to put some of the stock and some of the benefit into employees. And then over time, perhaps when you're ready to actually go on to the next venture, you can transition the rest of that stock in. So I just wanted to clarify that it doesn't have to be 100% of that ownership.
Really great points, and great clarity about potential ways to move forward that can kind of move with the flow of the challenges that startups face. Well, Sarah, if you can believe it, we're at the end of our time, but I don't want to move forward without asking, what is the best way that people can follow your work?
Thanks for asking that. Yeah, certainly visiting our website. We're at alternativeownership.com. We have a ton of resources, I have to say, there. You can do a lot of reading, FAQs, blog posts, references to other organizations doing cool work. We also do a monthly newsletter, which you can sign up, which is a good way to kind of hear about what's going on with the latest news. This month's newsletter was all about employee ownership. So it was like a roundup of employee ownership resources. And finally, you can find us on LinkedIn.
So we'll put those links down below the video so folks can connect with you. So thank you so much for being with us. You're so incredibly well-spoken and have such great expertise in this field. And we feel really grateful that you shared it with us. Thank you.
Well, thanks for having me. It's great to have more and more opportunities to share the news around employee ownership and employee ownership trusts.
Yeah, excellent. Okay, and for our audience, thank you for joining us. And we hope that this podcast has enlightened you to explore employee ownership, either as a startup founder, entrepreneur, or even as an employee. And let us know what your thoughts are about this entire movement. And be sure to tune in next week when we'll continue our exploration of employee ownership and how it's reshaping the post-pandemic workplace. We welcome you to join our community and help others find us by liking, sharing, and subscribing. And with that, thanks again, Sarah. And thanks again, everyone. Have a great week.